On today's episode of Southern Character, I am in Atlanta, Georgia, joined by certified public accountant Jason Toole. Jason is a partner with Kelley, Sammons, Toole, and Ellison. He's a graduate of the University of Georgia and has over 27 years experience as a tax professional providing income tax and business advisory services to a variety of clients, including corporations, partnerships, nonprofits, individuals, and estates. Jason focuses on tax planning for closely held businesses with multi-state corporate and flow-through entity taxation, as well as providing solutions for complex family tax issues, especially those involving estate and gift tax strategies. So when it comes to income tax strategy, Jason truly is a man for all seasons. Outside of work, Jason is happily married to his wife, Christina, and is father to 3 daughters, Kiki, Lola, and Nina. Jason, welcome to Southern Character. How are you doing?
Glad to be here. Yeah, that sounds like somebody might know what they're doing. I don't know. When you say all that, it just seems like a lot.
Is it humbling in any way? I mean,
not really.
No.
It's just we just cover so much. There's so much ground, and a lot of it is it's just practical too. There's a lot that's code section specific or tax nuance or related to some new tax rule. But there's a lot of it that's just what we see is very practical. And so when you start going through all those various issues, I mean, it just starts, like one thing after another, and you think, man, we just wear a lot of hats.
You do.
That's what it is.
And it's not that there isn't enough material that the IRS throws at you. I don't remember. I mean, I remember when I was getting my MBA, I had to take business accounting tax classes, Sarbanes-Oxley, How many pages roughly are in the IRC and the Internal Revenue Code?
Oh, my God. So this is a great question. My older partners can remember having a desktop book of the Internal Revenue Code. Now with the regs and everything, it's thousands of pages. It's like 6,000 pages or something. It takes volumes of books that stretch across 2 rows or 3 rows of a shelving cabinet. It's voluminous and it's only growing.
So we're going to take a step back. So we know. So I'm sitting here in the offices of Kelley, Sammons, Toole, and Ellison. So you are a partner here. How long have you been with this firm?
I started in a variation of this firm back in 1997. I got out of the University of Georgia.
So literally right after graduation.
Right after school. I started working in accounting when, Sarbanes-Oxley was starting up. There was right before that, Arthur Anderson was imploding. A few years right before that. But more importantly, everything at that point was geared to Y2K.
That's right.
And so all of my buddies and all my friends, everybody I went to school with, everybody was going into IT because there were so many jobs. And, that was such a big deal going into right before the millennium.
It's funny that you bring that up because I remember now Y2K. And I remember the fear circulating, and planes were literally going to fall out of the sky because the code. And God, that's funny.
We had a guys trip that we flew out to Lake Tahoe, and there was somebody
on New Year's Eve.
On New Year's Eve, and there was some discussions about being in the air to make sure everybody gets out here, and and then of course, we were out there in a ski town and at that age, and it was just funny because there was this air in the room at about 11:30, 11:45. People were starting to, it was just different. People were waiting for the shoe to drop. They were waiting for something to happen. And the ball dropped and midnight came and nothing happened.
Nothing happened. No, I remember. It's like we were all like bracing.
And people were like, I remember getting up the next morning, there was advertising, people talking about on TV, computers were starting up and there was no meltdown. Just,
where's the fire?
Where's the fire?
So let's go back. So, did you grow up in Georgia? Let's just start there.
I did. I grew up in Albany.
Albany, Georgia.
Albany.
Way down south.
Yes, down south.
Near the Florida-Georgia line?
Yes, near the Florida-Georgia line on the Flint River. Yes.
Okay.
Home of Luke Bryant and Buster Posey. That's who I say that. Okay. Those are probably your 2 more popular names. Buster played baseball for San Francisco for a number of years.
So you grew up in South Georgia.
Mm-hmm.
love the Bulldogs.
Yes.
And that pulls you to Athens.
Yes. I only applied to one college, which was Athens State School. I was the first graduating class of the Hope Scholarship.
Interesting.
Yeah. So my senior year in high school, Zell Miller passed it in February, and off I went to Georgia on the Hope.
Awesome.
So easy.
So what year did you graduate from high school?
93.
Okay, so we graduated in the same year. So you graduate in 93, clearly graduated in 4 years.
Yes.
Good student, 1997.
Yep.
Graduate, what was your degree in?
It was a Bachelor's of Business Administration, BBA in accounting, focus in accounting.
And so how did you land your first gig with?
Yeah, so I interviewed with a couple of firms here in town. My GPA after being in Athens, I actually it's a weird story. I did very well in my business classes with the exception of accounting. I struggled with accounting. And I do think, I was on the phone with an attorney the other day, and we were negotiating there was a real estate transaction up in Virginia. And when we were done, we ended the call, and he called me back, and he said something to the effect, he's like, that attorney's going to call you. He said, the way you laid out that presentation, the way you talked about the tax components and what that's going to look like on the tax return and how that's going to affect all the members and the disclosures. And he said the attorney's like, he was blown away. And I started laughing. I said, well, that's because I always have to dumb it down for myself first. I always have to break it into pieces, which I talked about, and break it into pieces and then put it in a way that most people can understand. And I do that for myself. Accounting was like an uphill battle for me. I just didn't like it. I was told by my cost accounting professor, she's like, you really should go into sales. You should not be an accountant. And I remember thinking about that at the time. I was like, yeah, I guess I probably should. I'm probably beating my head against the wall. It wasn't that I was failing. I just wasn't doing that great.
So how did you accept the calling? How did you end up here?
Because I took a class. I was taking classes at Georgia, and it was, what's one of the best business degrees you can get? They're like, well, accounting. And they're like, yeah, finance is good. I was like, yeah, finance, everybody's in finance. And so I navigated to accounting. I didn't like it, but I came to Atlanta, and I interviewed with the firm at the time, and there was a couple of partners at this firm, and one of them was a character. In fact, several of them were very gregarious, just over-the-top personalities. And I said, yeah, I could work here. This would be fun. And it was. It was a learning experience. It was fun. But what I learned practicing in a market where we're not really working with publicly traded companies, it's all closely held businesses. Mm-hmm. A company it could be a small startup, 250,000 a year in revenue, or even smaller, up to 400 million. So being exposed to that, you were exposed to people that they had a desire to do something. They broke the mold. They decided they were not going to work for a company. They decided they were going to do something for themselves. And that's where it always starts. It's like, I think I can do this better myself than going to work for somebody else. Mm-hmm. And I think that I'm willing to accept the risk, and I'm also willing to, I'm looking for the reward. That's what drew me into working in the public accounting space. And I honestly thought that I'd probably work here a couple years, get my degree, and then I would move on. I actually thought I was going to I started down the road of getting my CFP, maybe I was going to go manage money, but I truly kind of started embracing helping people with tax. And that really is it. That's the more I did it, the more entrenched I got. It just kind of blossomed. It just compounded. It built. Everything you learn, you can apply on another case, and just builds. And after a number of years, I just felt pretty confident and comfortable with it. So I started picking up clients when I was in my mid-20s. 2 years in, I started picking up my own clients, and by age 32, I'd made partner.
That's awesome. So Christina.
Yes.
Did you guys meet in college, after college? Is she from Albany too?
She was originally from Miami, Florida. Her dad was Cuban. Great stories on their migration from Cuba in '59, I believe, which was a year after Castro took over. Once they privatized businesses, they left on a Pan Am flight the next day. Wow. And great stories. Her grandfather was one of the coolest men I've ever had the pleasure of meeting. He and his brothers ran a company that was a joint venture with Colgate-Palmolive. It was the largest employer in Cuba. And, of course, that went away overnight. But her father came to Miami. He came to Georgia Tech, was an engineer, and met my wife's mother who was a nursing student at Georgia Baptist. And they stayed in Georgia and then moved to Miami, which was where Christina was born. And they separated after a number of years, and Christina moved back to Albany. And I grew up in Albany, and I met Christina within just a few months before I left Georgia. So I met her and then left. And
so it's like the summer of love. Before you leave to go to college, you met Christina?
Yep.
Like high school senior, and you meet.
Yeah.
And then you go to Athens.
Yep. And so we had a long distance relationship, and which was interesting. And then she came to Athens, and I was there for a year or two with her, and then I graduated in the 4-year program, and she stayed in Athens, and then went to Valdosta at the time, and got a master's in speech therapy. So we were on different tracks for a period of time, but I was able to stay in her good graces enough to where over a period of time we were able to kind of unite. And so when she finished her program, she came to Atlanta, and the rest is history.
So what year did you guys get married?
We got married in 2001. Her ideal honeymoon was to go on a Greek island cruise or a trip, and 9/11 happened in September, and that all went away, so we ended up going to the Caribbean. So I still owe her that Greek island cruise.
Well, there's still time.
There's still time.
So, and this is how we got to know each other. You have 3 daughters, and I love the nicknames or the acronyms. So Kiki, Lola, Nina. Plus, you have 2 dogs, Libby and Nestle. But so Kiki, because it's summertime, school's out. So the way I conceptualize, Kiki is going into 4th grade next year.
Kiki will be 4th grade.
So rising 4th grader.
Yes.
Lola is going into 8th grade.
Yes.
And Nina's going to be a senior in high school.
High school senior already.
How scary is that?
It just happened fast.
And so according to some sources, apparently she's pre-med in dermatology. Like what's that all? Is she taking like pre-med classes for?
She's going to Innovation Academy up in Alpharetta.
Oh, okay, yeah.
Props to that school. It's an incredible program because I guess when the freshmen get there, they quickly learn that this is not going to be the status program, the status quo. There's just a different level of expectation that's put on them. And, it's a flex schedule. Most of their days are, Monday through Thursday, probably every other Friday they're off. But it's geared toward like engineering, math, computer science, and medical. And so Nina quickly knew that she was going to go through the medical program, and that was what drew her to the school. She's had an interest in dermatology for a number of years, but as she's progressed through the school, it's only intensified. This summer, she has spent most of her free days at Grady, getting a very hands-on
Grady Hospital.
Very hands-on experience in the trauma unit at Grady Hospital.
That's amazing. So she's going to have like applicable college credits rolling into college.
Yeah, she's apparently in the program. There's some nursing courses and certificates that you can take, and so it's very hands-on, and the things that she's learning is just so far advanced. Her grandmother, Christina's mother, was a emergency room nurse, an OR nurse, a transplant nurse, did a lot of things over her career. And when Nina tells her the things that she's doing in high school, my mother-in-law, who is a retired nurse, is like, we weren't doing that until we started practicing. I mean, the things that she's seeing at a young age. So she's excited. It's up to her. Georgia needs doctors. There's a huge demand for doctors.
That's fair. So I mentioned this is how we know each other, and it's funny. So Lola and my stepdaughter Davis, are basically besties.
Yeah, and Lola's my feisty child. She's probably more like me.
She's feisty. Well, I have to tell you that Lola is probably the most polite 13-year-old I've ever met. You remember, she came to spring break with us.
Yes.
And just blew me away. She was so helpful, so willing to help. I mean, there was one morning, Amanda and I were making breakfast, and your daughter, Lola, rolls into the kitchen, and she's just like, hey, good morning. How are you doing, Mr. and Mrs. Lewis? And we're like, great, Lola, how are you? And she's like, yeah, so I just want to let you know, I took all the clothes out of the dryer and folded those. I took the wet clothes from the washing machine and started those. Is there anything else I can help you with this morning? I'm like, oh, who are you? So I don't know what you guys are doing. And I don't know if she does that at home, but she did it for us. And
no, the truth is that she probably doesn't do it at home, but that's not what we care about. Okay. What we do care about is the fact that she does it outside of the home.
Yes. She's extremely polite. And so another connection point too. So Davis and Lola are besties, and Christina, your wife, teaches at the school that my stepson, Amanda's son, Will, goes to Spalding Drive Elementary. And actually, they were together yesterday. So Christina and my wife, Amanda, your wife, my wife, Lola, Davis, all the kids went to Six Flags. And I don't know if you know this, but by the way, congratulations, you're a season pass holder now.
I heard there was an economic proposition made, so yes, I'm a season pass holder.
They crunched the numbers on the tickets versus, and it pays for itself after the second visit.
Of course,
and it includes parking. I got the whole breakdown.
Of course, it does.
So this is a good place to transition to start talking about a little tax. And before I do that, I'm just going to go ahead and throw out the obligatory disclaimer that Jason and I today on this episode of Southern Character are not giving tax advice. Tax advice is very specialized, and anything that we talk about today is just going to be, we're going to speak things about generally, but we're going to get a little granular, but not too granular. But anybody hears anything today, it's kind of like in investments, the disclaimer is past performance is not indicative of future results.
Future results, yes.
Tax situations are very specific to the individual. If there's anything that you have questions about, either talk to your CPA or give Jason a call. And that's absolutely, just want to get that out there. Now that that's out of the way. All right. So the disclaimer's out there.
Yes.
So one of the first questions, so our wives were together yesterday, and they were apparently talking not only about the membership to Six Flags, but Christina and Amanda were talking about this. So let's just pretend for a second.
They were talking about getting a second job.
They're talking about the kids, and I think this is pretty relevant because I know a lot of people that have kids that, let's just say Lola got into babysitting, or someone runs a little, I don't want to say runs a daycare or a livery, but I know boys and girls growing up that have run little summer camps. And actually, I had one friend who had a daughter that made $15,000 a summer, basically running these little, they called it Camp Cupcake, and she would make $15,000 a summer. So if you have a child that is making income like that, let's just say Lola is crushing it in the Babysitters Club. Is that how does the child have to fill out a tax return? Is that taxable to the parent? How does that work?
Well, there's legally what the law says.
Let's stay legal.
Yeah,
let's keep it legal, Toole.
Let's stay legal.
Okay.
So what the law says is once you get above a certain dollar amount, you're going to have a taxable income issue. And a certain dollar amount, is case by case, but in theory, there's going to be a standard deduction that you're going to take. Now, the child is going to be the dependent of another, so they're going to be claimed by somebody else. But there's still a layer of income that you can make that income, a couple $1,000s, and you'd report a tax return. There'd be no tax. Now, that's income tax. There's also this thing called SE tax or self-employment tax, and a lot of people tend to forget about that. That starts at a much lower threshold. So what you'll find is kids that may make $4,000 or $5,000 don't really have an income tax burden. But now all of a sudden they owe about 10%. They got a $500 tax bill to the feds, to the IRS for self-employment tax. So it starts at a low. Believe it or not, it starts at a low threshold. When you get to $15,000 is if a child is earning that much money. I mean, as a parent, what you probably should be thinking about is how can we, put that into a savings vehicle.
So that's where that's where I wanted to go next. So number one, is there a case where literally Lola would have to file a tax return?
Yes.
Okay.
Yeah.
In Lola's name,
with Lola's name, she's making $15,000. And, and it's in some form of where it's being recognized. So she's reporting it. That's $15,000 that she's reporting, even though she's a dependent of mine. And so now she has this $15,000 burden. Of course, we're going to ask questions like, well, did we incur any cost? Were we driving you from point A to point B in various places? Or, did you have uniforms? Did you have marketing? Were you using any digital technology?
So business expenses.
Oh, yeah. So we're trying to figure out how to whittle that number down. But at the end of the day, she's still going to have profit, and that profit is going to be subject to tax. It's going to be subject to an income tax as a single taxpayer, and then it's also going to most likely be subject to self-employment tax because she's not incorporated.
Right.
This is a service that she provided, and it's subject to self-employment tax. And so then it becomes, well, what can we do to minimize these? How can we reduce it? And what I'm thinking about from whether it's Lola or someone else like that is, what's more important? Is it the money now, or is it the ability to take something and create a vehicle that will benefit her down the road at a much greater amount, have a greater return?
So because now she has earned income.
Yes.
In my world, I would say, okay, she's got a couple of options. She could take that earned income subject to limits. She could open up a Roth account.
Yes.
She could open up an IRA account, or she could open up a custodial brokerage account. I guess at this point, all these would be custodial if she was a minor, maybe. I guess that part really doesn't matter. But is it, because her income, like say, hey, she makes, $4,000, her income is so low, so she can contribute it to the Roth, right? If she wanted to. She could, I guess, contribute it. Could she contribute to a deductible IRA? I mean, is that fair game?
Income that's subject to self-employment tax, you can fund an IRA.
Okay. So in that vein, would you say, hey, Lola, throw it in the IRA so you can deduct it so you don't have to pay taxes on it? Or would you say put the after-tax income in the Roth? Like, where does Jason Toole stand on this? How would you, what would you tell your daughter?
At these levels, This is the lowest tax rate that she'll ever pay. Being able to put away, I'm just going to use a random number, $5,000 into a Roth IRA. And I know the number is higher. You can be $7,500 this year or whatever, but just $5,000. Just keep it simple. If she was able to do that for 2 or 3 years before she, as a middle schooler going into high school, or when she gets out of high school, she's got $15,000, $20,000 in a Roth, and she doesn't do anything with it through college, and then she gets out, and then maybe she starts funding it later. That $20,000 at that young age is just like such a fire starter.
Yeah, it's like lightning in a bottle.
It's lightning in a bottle. It is huge.
Yep.
And what that does for her over the next 50 years is incredible. It's funny. We're talking about Lola or that young child, and the opposite end of the spectrum, are going to be people like me and you and all our peers and everybody else who's getting close to retirement, and everything we've done is in a deferred account of some, the old deferral, 401k or an IRA. And then, once we get into this magical age, then we start taking out, and everything in it's taxable. And so being able to put something away at such a young age when it doesn't really cost you anything to do it, and then you're never going to pay tax on it, that is, as you said, lightning in a bottle. It's incredible.
So, and actually, that's a good, so let's transition a little bit away from Lola and move up the food chain a little bit. So let's just say, James Lewis today. James Lewis today is, instead of making the 13-year-old babysitter income, James Lewis today is making, a big boy salary.
Yeah.
Right. And Amanda's making a big girl salary. And we're in our, I'll give us a little bit of grace on age. Let's just say we're in our mid-40s. So we have real income, real families, and we're in our mid-40s. And you ask 10 different people this question, you get 10 different answers. In your opinion, is it better, should James be thinking about reducing taxable income today in a deferred account? Because future James, when James is retired, James is going to have a lower income. So don't tax me today, tax me tomorrow,
later.
Right?
That's right.
Because tomorrow in the future, James is going to have a lower income and be in a lower tax bracket, and it's okay that the distributions are taxable. Or, should James be thinking, well, maybe I should be, it doesn't have to be all or none, but should I be thinking more about, well, maybe I should do the Roth 401k today so that in the future I pay the taxes now and don't pay any later? I know there's no one size fits all answer to that, but
the proverbial kick the can down the road. That's what that is.
Okay.
Yeah. Should I kick the can down the road?
Yes.
Or should I pay it now?
Right.
Yeah, I think it's a personality thing. I really believe more than personality, though. I think it's more of a lifestyle / cash flow question. Because between you and your wife, if you're working together, you have the ability, and again, using round numbers, but you have the ability to put away probably close to $40,000 of earned income. And that's a lot of money for a lot of people. And, and so a lot of times when people come to the office, what can I do? And the first thing you say is, are you maxing out your retirement plan?
Right.
Because that is by far the most advantageous thing for a W-2 employee to do, or just, the average person. And so combined, that's a lot of money. So saying, hey, if you put away $40,000 into a tax-deferred plan and your effective tax rate is 30%, well, that just saved you $12,000.
Right.
Well, that's $1,000 a month. Well, all of a sudden, that's a lot of money. I can do something with $1,000. That's meaningful. And so it becomes this, can you put away $40,000 tax deferred, or do you want to put away $40,000 into like, a Roth 401k, the similar numbers, but now you're putting it after tax.
Right. But
in order to put away $40,000, it's going to cost you $55,000 to do it. Well, what do you mean? Now I got to pay $13,000 in tax instead of getting a $12,000 benefit? And all of a sudden that starts becoming a cash flow thing. It's more of a budget thing. It's a lifestyle issue. It's, can you afford to do it? Obviously, in my opinion, the best answer is to pay tax now and not pay tax later, because the true value of compounding interest, time value of money, that appreciation over time, over the next even 30 years, overcomes whatever this disparity in the tax rate is versus now versus, it's huge.
Okay, so you're saying pay tax now, like go the 401k Roth.
If you can afford it.
If you can afford it.
And again, it's a big ask, because getting people to max out their retirement accounts is one thing. Then getting them to take it one step further and possibly putting into a Roth 401k, that's a whole different animal, because now I'm saying I'm gonna make you pay tax on it, and that's a huge gap. That's what I see. So the answer is yes, you defer it, but I'm also practical in the fact that I think the best thing you can do is to put away retirement funds, and the reason why is because it's something you don't touch. Yep. In most cases, unless you need to. And so whatever I can do to encourage people to put money away, I'm all for it. That's a home run.
And I think that's a great way to frame it. First of all, every case is different, right? Every situation is different. That being said, you could argue it both ways. Pay taxes now versus pay taxes later. But I think the bigger point is do something, right? Either way, like whether you do the 401k traditional or the 401k Roth, or maybe a blend of the two. Because I do know that, and like we could get super granular on this, like based on Secure Act 2.0, like once you turn 50 and you're making a certain amount of money, that before you turn 50, you put in a certain amount of money, that's $22,000 a year. After you're 50, there's a catch-up provision, but once you hit that catch-up provision, if you're making a certain amount of money, you have to put it in the Roth, the catch-up piece.
That is correct.
And I don't mean catch up like you pour in a burger. I mean catch up like catch up to me.
That is correct. And the Secure 2.0 Act is new. Right. This is recently passed. And also there's some phase-in provisions of Secure 2.0. And so this is one of those things where you definitely say, please talk to your tax advisor. Mm-hmm. This is where it starts getting, slippery, because there's a lot of information. The Secure 2.0 was a huge piece of legislation. It has a huge impact, big impact on tax deferral, tax savings plans, and it's opening the door for a lot of people at lower levels to start putting in money, in what they call these small 401k plans, and these, there's a lot in there, and whether it's IRAs or the small 401k plans, there's a lot of new information.
Right, wrong, or indifferent. I've just been maxing out my traditional 401k. I tell Amanda and myself, let's max out the 401k. Let's take that off the table. Because to your point, and let's just say, hey, we're making $200,000 a year. If we put $40,000 into the 401k, now the IRS is only taxing us on $160,000, not $200,000. And that's kind of the whole point. But to your point, later on when you take it out, then you're paying taxes on it. But so I'm like, hey, let's max out the 401k. Let's max out the health savings account, right? But let's just pretend for a second that I change my mind. I'm going to go the Roth 401k. What are other ways that I can reduce my taxable income that you would recommend?
Let's start with the fact that you max out your 401k and you max out your employer-provided HSA, or you got your single-sourced HSA, self-sourced. I would say, obviously, the one thing that I always tell people to talk to their broker, their financial advisor, is what they call the backdoor Roth.
The backdoor Roth. Yeah.
Because it's a great opportunity, and this is where you get into the nuances of the law. It doesn't make any sense.
Let's take one step.
Yes.
You're maxing out your traditional 401k.
Maxing out my traditional 401k.
Now we're going back to our Roth.
Yeah,
okay.
and we're just using round numbers. You, husband and wife, put away $40,000. What else do? We don't like paying taxes.
Go for it.
And this is where you say, well, and again, I think the Roth contribution limit $7,500 this year, or is it $8,000? I can't. It doesn't matter.
I believe it's $7,500.
Yeah, $7,500. So now, husband and wife have the option of funding what they call a backdoor Roth. So the rules on the Roth are archaic in the sense that they put a lot of limitations on your ability to contribute. So if you're making over a certain dollar amount, taxable income wise, you cannot contribute to a Roth. If you are funding through an employer provided plan, you have limitations on a contribution to on a deductible IRA or a Roth. So there's limitations there. Mm-hmm. However, the loophole, and that is what it is, and that is truly what it is in this case of a husband and wife maxing out their 401ks, they can go down to their broker, their local financial advisor, and set up a investment retirement account, an individual retirement account, an IRA, and they can fund that account with $7,500. They can let it sit there and grow some moss and earn some interest for 3 or 4 days, and then they can immediately roll that into a Roth IRA. And so the benefit of doing that is that's now between husband and wife, I put $15,000 into an IRA. And what I like to tell people is if you're putting $15,000 aside into like a savings account, well, this is the same money you should be thinking about a backdoor Roth.
Right.
Because now this money is now going into this IRA converted to a Roth. Now this money is going to now run its course over the however long you keep it in there, tax-free. If you can get above age 59, you can pull it out penalty-free and tax-free. And that's a wonderful tool versus you saving money aside for a rainy day or building up funds outside your retirement account. That's going to be like the Florida Getaway Home Fund or whatever. Mm-hmm. You need $200,000 or whatever it is. Now all of a sudden it's in a Roth and it's going to grow tax free. And they call it the backdoor Roth because you're kind of moving around the rules. You're backdooring it into this Roth, and the benefit is it saves you money. Going back to what we talked about before, you've already paid tax on this money.
Right.
You maxed out your 401k, you brought home your net paycheck, you put money in a bank account, and now you're like, what can I do? And so you take some of that money and you fund an IRA. And that money is not deductible. That contribution to the IRA is not deductible because you don't meet the requirements. And that's where we get limited. But the benefit of putting it into the Roth is a huge benefit. Over a 10-year period, that's $150,000. Over a 20-year period, that's $300,000. And that's before we start talking about appreciation.
I'll just bottom line it. I haven't met a single person yet, working or not working, that enjoys paying taxes. I have yet to meet that person. So what are some ways, if you don't have...
But I get more phone calls, though, about people that have had large income events or transitions in life. I always refer to it as the second half. You do what you do because you need to do it for the first 25 or 30 years, and then there's a buyout, there's a sale event, there's something, maybe you inherit some money, I don't know what it is, but then all of a sudden you transition. You're like, I've always done this and I've done it well, but I did it well to make money. But, I don't want to retire. I want to go do something different. And I think that, I always love that. I always love having conversations with people because I think that's what this generation's figuring out. Our parents' generation missed that boat because they were the first generation that got to retirement age and they were still alive. They began to actually retire, and it became a problem because everybody had this, panacea, this false, this hope of what retirement might look like. I'm going to work all these years, I'm going to get retirement, it's going to be great. Well, actually what happened was people retired and they got bored. And then, statistics show a lot of people are dying within the first 5 years of retirement because they had nothing to fill their day and
their purpose.
Their purpose.
Right.
And so I always like talking to people about this, this second phase. But we get more and more calls now about people that have deferred a lot of money, and it's in retirement accounts, employer provided accounts that they've contributed to, and now they're 60 years old and they've got this period where they're going to do something different, but they're not going to start drawing Medicare yet, and Social Security is even further down the road, and they're going to start this new practice and this new business, and I'm probably going to spend another 2 or 3 years kind of figuring this out, and my income is going to be drastically low. Mm-hmm. And then all of a sudden the question becomes, hey, should we convert some of our money into a Roth? And that's when you kind of light up and you say, well, yeah. I mean, how long do you think we're going to live? I mean, what's your life expectancy? What was your parents? How long did they live? I mean, that's a great indication. And so, well, yeah, my dad lived till he's 85. Well, chances are you may live till 90. So that's 30 years from now. So if we take some of your money out of a retirement account and actually convert it to a Roth, we're going to pay the tax on it right now. But if it's a low income year, what if we're paying taxes at 15%?
Right.
That's a great win.
Right.
That is a great win.
Before Secure Act and Secure Act 2.0, the common moniker was like, okay, I retire at 60. While I was working, I just did traditional 401k. I don't want to pay the taxes today. Reduce my taxable. So while I'm working, 401k, 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 then I retire at 60. I roll it all into an IRA.
Yes.
And at some point, and the age used to be 70 and a half, the IRS comes in and says, hey, James, hey, Jason, once you turn 70 and a half, you have to start taking money out of here. You have to start taking...
It was like that for the past 25 years of my practice.
You have to take your required minimum distribution.
Yes.
And now Secure Act and Secure Act 2.0 upped it to 72 and then 73, 75, right?
There you go.
And so what you're talking about now is like, say you retire at 60 and you have a 13-year window to do conversions to, yes, pay the taxes on them, but get the money over to a Roth, but do it in a way, because if you work with a CPA, if you work with someone like Jason, you can manage that taxable income, because you don't want to like throw yourself into the 37% or the highest possible tax bracket to do it. It's about managing that bracket. And also, if you're like 65 and making Roth conversions, you kind of have to watch it because of the Medicare premium. If you convert too much, you can jack up your Medicare premium.
That is correct.
You got to be aware of that.
That is correct.
So you
have windows of time, and right. This is how you said earlier, case by case. It's different for everybody, but there's windows of time where it makes sense, and there's also brackets or tax brackets, or what I like to call tax buckets. You can fill your bucket up, and then you have to go up to the next level. And so those are, spacing, or however you want to put it. There's a lot of different ways, monikers you can, handles you can put on it. But ultimately, what you're trying to do is, if you're thinking about converting income in a low income tax year.
Yep. Right. I love it.
Which then has a huge benefit down the road.
Totally. So let's focus on, let's get a little Southern.
Okay.
Let's focus on the Southern, because of the Southern character. We're on the show today. You're a Southern character. Can find everything.
The South is a good place to be.
The South is a great place.
The South.
This is why I started Retire Southern.
The South used to get a bad name. It was. I don't know if it was uneducated. It was.
Oh, of course.
It was backwoods. It was heavy agriculture, and and what's happened over time is started here in the 80s. It was the Rust Belt. It was this northern, this different. And so what's happened is there's been a huge migration of people, not just recently because of, the world events, but just in general. And right. And the South has come into its own. It's it's blossomed. And so there's
I feel like we've evolved.
We have. And we've evolved because we're no longer tied to horse and plow. I mean, right. There's a lot of activity, and there's a lot of business. There's a lot of creative people. There's a lot of brilliant people, and they're doing there's a lot of activity in the southern states. And again, I laugh because it wasn't like this way. It wasn't like this. This is new, and so we're kind of like in the new South. We really are.
So you mentioned at the beginning multi-state returns entities. I would imagine you're pretty familiar with whether it's Texas, Louisiana, Kentucky, Tennessee, North Carolina, all the good stuff there. So if I'm looking at tax friendliness,
yes,
right, of states, let's just start with something like Social Security. So
yes.
If I'm going to retire in the South and I'm going to fire up my Social Security benefit. Are there any states that tax Social Security?
You've come to the right place.
Okay, good.
Nope. There's not. No southern states.
Welcome to the South.
Welcome to the South.
Any state in the Southeast, they're not going to tax your Social Security.
No, sir.
I love that.
Blue states only is what we call red and blue. Blue states, say it, but yep, blue states only. North of a line, however you want to say it, southern states, southeast, no. Yep. They do not tax your Social Security.
And I'm not calling anybody out, but like Rhode Island, they're going to tax your Social Security.
Chances are yes.
Right. Utah, Vermont, beautiful places.
Yeah, there's some states up there, but so I shouldn't disparage all the states outside the South. There's actually some states that do not tax Social Security or any income tax, and so we have to call that out. But the key here is focusing on the South.
Of course.
If you come to the South, your Social Security benefits will not be taxed.
Will not be taxed.
That is correct.
Now, there are a few states in the South that do not. So it doesn't. I guess it really doesn't matter where you go in the South. You're going to pay federal. Okay. Sorry, but you're going to pay federal.
Yes.
But there are some states in the South that do not have a state income tax.
Unless we include Puerto Rico as the South. And then all of a sudden you get to some nuances there. But that's a whole different
It is a U.S. territory, right?
It is a U.S. territory. And if you live there for more than 6 months, there are some very advantageous tax rates and tax benefits.
Are you serious?
Absolutely.
Because I love Old San Juan.
Well, you better love it for more than 6 months in a day.
Okay.
But
interesting.
Very, very beneficial. And
maybe we could do a 2.0 show on living in Puerto Rico.
There is some scrutiny on that, but believe it or not, it has stood up over decades. So,
are you and Christina knocking this around potentially?
She wants to go further south. I'm not sure Puerto Rico. Although 6 months out of the year, I mean, depending, if it's October through April. I mean,
6 months in a day.
Yeah, that's 6 months in a day. I think I could do that. Okay. So back to your question, though.
No state income tax in the South.
Yeah, so no state income taxes. Our state to the south, Florida, state to the north of us, Tennessee, and the big state of Texas. Those are the no state income taxes states in the South. That is correct.
So I get a lot of people asking me, well, hey, whether I'm retired or when I'm still working, I'm going to retire, should I move to one of these three states? And if I want to stay in the South and I don't want to pay a state income tax, should I just go ahead and transfer, to Florida, Tennessee, or Texas? Or, like, in your opinion, is there a trade-off for doing that? Like, are they getting you somewhere else if they're not getting you on the state tax?
I think there are trade-offs. I think there's other caveats too. I think pension income is a big deal. I think certain states do not tax pension income, and certain states in the South only have partial taxation limits or income above a certain dollar amount. I think Arkansas might have a $6,000 threshold. You have to have more than that. But certain states like Mississippi and Alabama, they don't tax pension income. I think South Carolina is a partial state. So there's several states that only tax pension income partially. Georgia, as you know, has a great retirement plan exclusion of $35,000 per taxpayer. So husband and wife, $35,000 for each. Starting at age 62, and then after 65, it goes to $65,000. And so there's nuances in each of the states. And then once you get past those nuances, then you're looking at which states you're paying tax in. And depending on your tax brackets, those tax rates are anywhere from 2% to 5%, predominantly in those states that we're paying tax.
Right.
And so it's a relatively a smaller percentage. It's not, some of our listeners or people that are coming down from the north who may have been used to paying 10, 11, 12, 13%. It's a far cry from that. Okay. But it is important to distinguish that, those outside of those three states, there is, we are paying income tax in the other states. There are trade-offs. I tell you, there's some great sites online, but you can look at quality of life, et cetera, as far as where do I retire? And in certain states, you want to look at things like access to health care. You want to look at, the healthcare system, the quality of the healthcare system. And then the other thing I think a lot of times that we see a lot is just insurance. Certain states, coastal states especially, warmer waters, warmer climates. I'm looking at you, Florida. Those are going to be high insurance states to insure property. And that's really... That's becoming more and more true as you start hearing more and more people that are unable to acquire property insurance for their residences because they live in coastal areas, and the burden of insurance, either A, they can't get it, or B, they can't afford it.
Right.
So there are some trade-offs.
And so when you're talking about Georgia and the various tax exclusions, I live here, I help people here, so I'm pretty familiar with Georgia, but I think Georgia's a pretty tax-friendly place. Yes, there's state income tax, but now we've moved, to the flat tax, which is going to consistently step down. But as a retiree, to your point, number one, if I'm retired in Georgia, number one, my Social Security is not getting taxed.
Correct.
And then if I have a pension, if I have an IRA distribution, dividends from my brokerage account, to your point, and I'm married, so Amanda and I each get a $65,000. So if we're 65 years old, we each get a $65,000 exclusion. So that's $130,000 between the two of us. So if I frame that for a second and say, okay, well, let's just pretend we're each getting, I'll just go $25,000 in Social Security. So we have $50,000 gross between the two of us in Social Security. Then Georgia, because we're 65, is going to give us another $130,000 exclusion on our IRA distributions, call it that. So we basically, $180,000 of our income in Georgia, we're not paying taxes on. So It's not no state income tax, because that's not correct to say that. But if you don't have $500,000 a year in income, if you have like $200,000 a year in income, and that's okay because you don't have, if your house is paid off and you don't have these expenses anymore, you can live on that and you're not paying any taxes on it in Georgia.
I will tell you from a standpoint of what I see a lot of retirees making quarterly estimated tax payments to the IRS.
Yeah.
Because they don't have those exclusions. So they have income that they're paying tax on at the federal level, and they're making estimated tax payments because they don't have a job, so they're making quarterly payments, but they're not paying anything to Georgia.
Right.
Because they don't owe anything to Georgia.
Right.
We see that. You see that quite a lot.
So you see a lot of Georgia clients that they pay federal, but they pay zero Georgia.
That's correct.
Yeah, because of the friendly exclusions. And you don't have to rank like each state in the South, but if you just want to throw out a handful, in your opinion, and again, this is just opinion, what do you think are the tax-friendliest states in the South?
Well, the three states that you don't pay tax in would be the most friendliest. However, there are trade-offs, a lot of trade-offs. I think, again, what I spoke about was access to health care. I also think property taxes are an issue in addition to state income taxes. Insurance is an issue. And then you get into the other issues like transportation, proximity to whether it's family or hospitals or churches or whatever it is that means something to you. I think you have to get through all those various issues. But listen, the numbers say Florida is where you want to be.
Okay.
Florida is where you want to be, even despite those
the insurance and the hurricanes.
Insurance, and the reason is because outside of Tampa, Clearwater, Miami, whatever, there's a lot of other dirt in Florida. You can live in Orlando or Jacksonville or anything in up and down the middle of the state of Florida, and it's going to be great because you're not going to run into those insurance issues, and you're going to live in a state with low cost of living and no taxes. But I'm partial to Georgia. I think Georgia's great. The reason why Georgia I think it separates itself from say Florida is because nobody talks about Georgia about tourism. Nobody says, hey, well, I'm going to go to Georgia and see something. I mean, sure, people want to come to Atlanta for whatever, but it's not Florida. Florida is truly a destination for tourism. Georgia holds its own when it comes to its economy, and Georgia holds its own when it comes to business and the economics of our state. And I think especially in Metro Atlanta, healthcare is really accessible. Depending on where you live in Atlanta, you can get on the outside of Atlanta. There's a lot of there's some affordable options. So I'm always partial to Georgia, but I got to say, the numbers tell me that Florida is probably number one. And let's not forget our friends over in Texas, because they're getting a lot of people moving into Texas too.
Yeah, there's a huge influx.
Of people. There's a lot of technology. There's a lot of things going on in Texas, but they have no tax rate. But I think you have to get a hat or at least a pair of boots if you move to Texas. They don't. You can't be there for more than 6 months. So you got to look good in a hat.
Yeah, I don't know. My head is physically too large.
It's going to be a big hat
for a hat.
It's going to be a big hat.
It's going to be a big hat.
Yeah, but I think you have to have a hat. Maybe you can get by with a pair of boots, but I think you have to have the hat.
A 10-gallon hat.
Yes,
it's feeling
a 10-gallon hat.
Flat.
Yes.
Okay, so since we talked a lot about tax friendly and retirement, so. And you brought up Florida, so, and you and Christina have a place down in Mexico Beach, Florida. So are Jason and Christina, are you guys targeting Florida as the phase 2?
Phase 2.
What is phase 2?
Yes, phase 2. That's exactly right. Phase 2 is going to be, my wife is going to work about 7 or 8 more years in the school system as a speech therapist, and then she will transition into something else. I don't know, but she'll probably still be working with children.
She's a teacher, so I'm just curious, is she under TRS, or is she like any kind of pension?
Yes,
okay.
Which is really weird because, a lot of people think that, they get this teacher pension and they get Social Security, but, if you start really reading into it, they're not paying into Social Security.
They're not paying in, right?
They're paying into the pension system. That's the government program. And so when they retire, it's their pension, but it's not Social Security. That's not they don't have any credits. And so she's on path to retire, and she'll have that pension.
Awesome.
Mexico Beach is where our second home is. We had a place in Mexico Beach that we had bought when we had small children, and we raised our children, and we went there. And it was just off the beaten path, the Forgotten Coast. That's what they call it.
Right.
And it's accessible. I still think the Gulf beaches are just really, that's what I grew up on. I've got a fondness for them. And so we would go down there. And then in 2018, Hurricane Michael came through and cleaned us out. And it was really interesting. For us, it became actually more personal, more meaningful, going a year plus without the place to go. Like, it was taken away. The very following year, we were not going down there, and we started missing it. And it was interesting. And I'll tell people this story. I said, that's really meaningful. When you find something that draws you for whatever reason, then you should go with it, because there's so many things, there's so many distractions, there's so many options in life, and you're bouncing around. And you really don't know if that sticks, or maybe I could do this, or maybe I could do that. But when you find something you like, you really should kind of follow that path.
Right.
And so the hurricane took it away, and probably the best thing that happened was we saw how much we missed the place. And so we rebuilt a house, and we're down there, and just love the area, love the people. I've got some clients down there. Slower pace.
What year did you rebuild the house? I'm just curious.
So we started in 20 and finished in 21.
And for people that might not be familiar with Mexico Beach or the Forgotten Coast, so Mexico Beach, I don't know, is it almost dead center in between Panama City and Port St. Joe, or it's in between the two, correct?
Sure, I'd say it's what I always say is it's Mexico Beach is just on the eastern tip of the large Air Force Base, Tyndall Air Force Base.
Tyndall Air Force Base. Okay.
Yeah, and it's the spot between what I would say Panama City and what I would say then Port St. Joe, Cape San Blas. It's that beach town between them,
mm-hmm.
and in the Forgotten Coast, it starts there, and it travels all the way through. Like we just said. Cape San Blas, Port St. Joe, but it goes over to Apalachicola, and then further over to St. Mark's and so that's the area that was forgotten. That's where the tourism, everything went west, and everything built up west, and this little area is still what I would call Old Florida.
Yeah, and we love it. Actually, on retiresouthern.com, I posted, there's a series of articles that I call the Forgotten Coast series. So it covers. I need to cover Mexico Beach. Maybe we should go to Mexico Beach.
We should do that over some beers at the new brewery, Forgotten Coast Brewery.
Okay.
In Mexico Beach. We should do that.
So let's do that. But yeah, so there's that. I talk about Cape San Blas, St. George Island, and Apalachicola.
Yes.
Because there's a great spot in Apalachicola, the Station Raw Bar. I don't know if you've been there, the old gas station that they converted, the Pendletons converted. But Mexico Beach is your happy place. So tell me.
And the Gibson Inn in Apalachicola, if you've never been, is incredible.
I haven't stayed there, but it's
incredible. Incredible.
But so Mexico Beach is your happy place. The Forgotten Coast Brewery, is that new?
Yeah, it's brand new. They just opened up about a month ago.
Is that right in Mexico Beach?
It is. There's a group of investors that have opened that. There's a place. There was a very well-known place in those parts. There was a Toucan's restaurant. It was a beach bar, and it was well-known. And it was completely destroyed. And the same investors are going to rebuild that. But there's also those same investors are looking at doing some work in Apalachicola too, because Apalachicola got hit by a storm and damaged one of my favorite places in Apalachicola, which was Boss Oyster. It was on the water, and so there's a group of people down there that are trying to revitalize several areas down there.
Okay, so Mexico Beach is your happy place. You mentioned the Forgotten Coast Brewery. Are there any other kind of like hidden gems, like maybe like your favorite spot, like if it's just you and Christina and you want to have a grown-ups night out without the girls, or like a good family spot? Like what would you, if someone's visiting Mexico Beach, what would you say, like, hey, if you want a fun date night, go here. If you need to take the kids somewhere, go here.
So I have to preface it by saying Mexico Beach is not the place where you go to kind of go out and be seen.
Okay. So it's not like a Rosemary or an Alice Beach.
This is not. No, this is the place that you go where you want to spend a lot of time with people that you're there with. Mm-hmm. So it's kind of important to like the people you're there with. So it really is. It's funny because you might be in a house of 20 people, extended family. You better make sure you like them, because you're going to be seeing a lot of them, because there's not a lot of distractions.
Okay.
It's a great time for me to go down there and just kind of like refocus and just kind of break away and clear my head and spend time with my family and
right.
and the girls. I think that's so important, because they'll still get their device time, but there's just not a lot of distractions. So there's a lot of one-on-one. Yeah. And very memorable, just a lot of memories that you can make. But as far as places to eat, so yeah, there's several places, in no particular order. Mango Marley's is a great little bar in Mexico Beach. They have a great football season. Do a lot of wings. They're shrimp baskets. The Shipwreck is a place in Mexico Beach where you can go for your seafood, etc. The Shell Shack is my favorite. But that doesn't mean you're eating out. That means you're eating in. You're going over there, you're buying the fresh catch, or they're steaming your shrimp for you, and you're taking it home, and you're doing a full spread, a country boil, if you will, or something at the house. I love the Shell Shack. There's moving through those parts. The view is over there past St. Joe Beach. It's the guy that runs that it's a great story. He was an ER doctor up in either West Virginia. He's Filipino, and he saw the storm that hit Mexico Beach, Hurricane Michael. He was watching it on TV, picked up the phone because he saw some articles about the hospitals down there, and nobody had a place to live. And he called him. He said, "Hey, I'm a doctor. I'm an ER doctor up here. You guys need any help?" And they're like, "Are you serious?" And he's like, "Yeah, I'm serious." And they said, "Well, yeah, we're desperate because like half our doctors they've all lost their houses. People are moving out. We're short on staff." He's like, "Well, that's cool. I don't need a house. I've got like a third well. I'm just going to bring it down. I'm going to live in it." And so he comes down, falls in love with the place, and then buys this restaurant. And so now he's running a restaurant called The View. And he's got like a couple of family recipes, and it's a great view overlooking the marsh. Okay. So the view's really good. And then when you get into Port St. Joe, Provisions is one of my favorites. There's a really good pizza place, Blackstone Pizza place there. And then you can get into Apalachicola. I would say the Owl. The Owl's one of my favorite places. Good. Yeah. Okay.
I'm curious because it sounds like you guys get out on the water, right? Mm-hmm. You love being out on the water. Have you? I haven't done this yet, and I want to do it. Have you guys gone scalloping in St. Joe Bay during scallop season? Have you guys done that?
Yes.
Okay. Is that fun?
It involved a bucket of beers, and it involved gloves to start with, but I couldn't determine what I was grabbing, so I took the gloves off, and then you started grabbing in the marsh on your hands and knees for scallops, and it was an ordeal because there was things that were biting back. But we filled up a bucket, and I think we made a linguine, scallop linguine, which was really good. definitely. But the scallop season down there is a ritual. It's an event. You have to do it at least once.
Yeah, I want to do it. So maybe we can do that together with a bucket of beers, and if something bites us, we can. Bite
something will bite because the problem is you can't. With the gloves, you lose your sense of feel, so you don't know what you're grabbing. But once you take the gloves off, you quickly learn. Yeah.
Well, I think that's a good place to wrap it. Jason, thank you for inviting me to your office and making taxes fun. So if anyone is interested and needs your help, needs your services, the name of your firm is Kelley, Sammons, Toole, and Ellison, KTSE. How do people get in touch with you? What's the best way to contact you?
Email address, jtoole with an E, TOOLE at KSTECPA.com. So the email is pretty simple. In the world that we live in, email is by far the most readily available, most useful tool. So,
okay.
Yeah.
So KSTECPA.com. It's Klondike Sierra Tango Echo CPA. Okay, got it.
Yep.
So thanks so much. You can find this episode of Southern Character and more on retiresouthern.com. You can also follow us on Instagram and Facebook at Retire Southern. Thanks for listening.
This information is provided to you as a resource for informational purposes only and is not to be viewed as specific recommendations. This information is being presented without consideration of the financial circumstances of any specific individual and might not be suitable for everyone. This information is not intended to and should not form a primary basis for any decision that you make. Always consult your own legal, tax, or investment advisor before making any financial planning considerations or decisions. The views and opinions expressed are for educational purposes only as of the date of production and may change without notice at any time based on numerous factors.